All right, good morning, everybody. Back at it on a short week. We've got a lot of Fed speakers today from around the world. ECB, BOE, and the US. Doesn't look like we're hedging into it much. 0.25% from Hong Kong to the downside, maybe closer to a half. And NASDAQ to the upside near a half. So we're kind of buffered on each side. We have auctions today in the front end. So if you're using something like IRX, kind of keep track of the really close dated stuff. Otherwise, it's kind of a quiet week. It's the third Friday of the month, so we have OPEX. Going to be a big deal. We should be seeing VIX as well on Wednesday. It's worth keeping an eye on Japan. There's been more talk about the cost of rice and them releasing strategic stockpiles, almost 0.25% of all of their strategic reserves. Last time they had issues with rice costs was back in August 2024. I know you may be thinking, who the heck cares about rice? But everything's connected. August 2024, if you remember, we had that VIX spike into 65. We had the Japan carry trade unwind. A lot of violent moves in the market. So today is very likely a day we're going to see a lot of headlines from outside sources, news that aren't necessarily connected to, what's moving the market, but they'll move the market. So, ongoing talks with Ukraine or about Ukraine, seems like they're leaving them out of the discussions for the moment. All right, we're back above the volatility trigger on everything. If you read the Spot Gamma founders note from Friday, they talked about, we're back into a cautionary green light environment as long as all of the indexes are maintaining above that volatility trigger. We're also in a positive gamma. You see the zero gamma line down here. And in a positive gamma environment, the dealers will sell into strength and they'll buy into weakness. So that's why rallies generally aren't as strong, and it's why sell-offs don't normally continue to sell off, right? They're running the other side of the trade. It's not to say that if we break out, we can't make a run for it, just that, it's always harder to get good big breakout days in a positive gamma environment to the upside because the dealers will be selling into it. Now that's where we were on Friday when it comes to the zero gamma level. We're still waiting for the AM edition of the Spot Gamma Founders Note to see where the Spot Gamma Index is at. Friday it was at 2.4. It only goes from a -4 to a +4. So if we're sitting at 2.5, then we're a lot closer to being maxed out at +4 than we are to being maxed out at -4. We are closer to the upper edge. The two red lines are the average daily range, which right now we're running at about 72 points. So if you think about where we were when we opened up Sunday night, we would split this 72 points in half, which is why we have two red lines. So we can make half of that 72 move to the upside, make half to the downside. On any typical normal day, we'll make the ADR and that'd be a wrap. If we get bullish, we can make that same 72-point move in a single direction, straight up to the yellow line or down to the yellow line. That's what we would call a full ADR, right? Make a full ADR move up or down. If we get some news or some headlines, that's certainly on the table. Otherwise, we don't really have much of a reason to move yet. We still got a lot of unknowns going on where the market is held in suspense, waiting for some of the answers that we're all looking for. We got the dollar below 107. That kind of needs to stick. So this is a little bit of a Busby. 107 was support. We finally broke it. Now it's coming up to test old support as new resistance. If this Busby plays out, it owes us back to the low. From there, we could get below 106.5. The current administration is strongly focused on getting this dollar down. So it's one piece of their plan. We had some decent moves last week in the 10-year, but that got unwound. We ran it back up. Now we're back above 4.5. It's kind of the line in the sand we need to get below. But bigger picture, we need it below 4.0. And right now we're moving in the wrong direction. All right. There's been times where I talk about the daily channel, and I mention how it can be so narrow of a channel, you don't even see a channel. You just see a line. And that's what we have this morning for the daily floor pivot channel. This channel is often called the CPR, Central Pivot Range. The pink line is the floor pivot, and it is such a narrow channel today, you can't even see it. When we have a narrow channel, it implies that breakouts can grow legs and we can really make a move. And if we have a really big channel like we had on Friday, it implies that even if we do attempt a breakout, it likely doesn't stick and we stay range bound for the day. Well, we are broke out of Friday's range. If you're new to trading futures and not quite sure why I'm still talking about Friday, is you don't want to focus on that half day yesterday with Monday. Just wrap it all together as Friday being one day and everything since Friday as the next day. So consider all of that Globex. We're broke out of Friday's range. We need to keep it. We had a nice Busby. It only owes us back to the top. But if you've done any work on the Busbys, you know that some of the best trends we've ever had in history started with price in a range. It broke the range, came back and validated old resistance as new support, and then began a trend that lasted for quite a while. So we got the breakout, we got the test. It owes us back to the top. We'll see what happens at that point, if it can continue to expand or not. One of the simplest metrics of where are we going next would be to measure the range that we broke out of and project that to the upside. $61.60. That would be the halfway point of this range that we just broke out of. A 100% of the range would be 61.72. We're above the weekly pivot. That's bullish. Today's floor pivot is higher than the previous days. That is also bullish. And price opened above it, and that is bullish. At the moment, we're riding on an MDP from Friday. That's a missed daily pivot. We didn't hit it on Friday, so it counts for today. And today we haven't hit the pivot, which would count for tomorrow. These often begin to pair together, right? You get one, then you get another one, another one. If you haven't gone through any of the material on missed daily pivots, it's not mine, but it is a trading strategy. You can find on YouTube, just type in missed daily pivots, you come across it. I don't trade the strategy, but learning the strategy gives some insight on how to use floor pivots for analysis. So even if you don't want to trade with it, you can still get something out of it. It works that way with a lot of strategies. At 61.32 cog line of last week is still kind of filtering in for this week. Just tie all of this together. If it had lasted just a little bit longer, it would have looked a lot like the week before last week when we had this double distribution in the lower point of control. So for the current week, of course, it's really narrow right now. We just got started. But this structure needs to hold. Otherwise, it's likely that we'll fall back through the shallow area really quick. We rose through this area really quick. We didn't leave much behind in the footprint. And it's likely if we break down, we'll run right back through it really fast without leaving much behind again on the other direction. And that'll put us back down below 6,100 into that 60.92 cog line area. Ten-day, 30-minute volume profile with TPO. The TPO is not reflecting the same as the volume profile up here at the 61.32 area. Sure, we got some trades, but it doesn't look anything like this volume over here. And that implies that there was a lot of volume in few trades, right? Another way to say it is there was just some really big trades that hit. We can get a lot of trading activity, bunch of, one lot, two lot trades. And then we would get, bigger blue bars on the right side, and we would have smaller green bars on the left, or at least equal size. And they're not equal. We got a lot more volume with less trades attached. So they were big trades. We're above that level. It'd be interesting to see it get tested just to see them validate the positions that they put on. But kind of goes back to the idea that if you really want to test it, you may be standing on thin ice, but that doesn't mean you need to jump up and down to check it. We're not expecting to see the point of control move anytime soon. We won't lose any of the candles that provided the point of control at its current location for a few days at least. So sure, if we stay in one spot for the next 3 days, we could move the point of control up. But considering we left that 60.32 behind, the only way it's going to move up to 60.32 now is if we go back, digest there, put a lot more volume in play, and have them jump up and down on thin ice and see if it's really going to hold. We have a VPOC from January. It's done. Finally ran through that today. No new VPOC. And so far this morning, volume and TPO are lined up, and they look really in unison this morning. They look like they're in agreement. Now, this volume profile doesn't put that Monday trading activity in with this overnight. And if it did, then it's possible that point of control would be lower, down into that 61.45 area. Either way, 61.32 is still the line in the sand. We can get weak. We can fade down into that 60.32. We could even overshoot it a little bit. But Friday's low is a low that we really need to keep. We don't want to get below that line. We're 1.5% above the 10-week. That's a good start, but we were there last week. It wasn't enough. Need to get a little further away. Don't get me wrong, 1% or more above the 10-week is fine. We're far enough away that it won't, pull us back like gravity. But it doesn't take much to drop back down below that 1% and then get caught back in that range. So the sweet spot is 2% above the 10-week. It's more of a bullish bias at that point. We got more follow through, I would say. But it's a good point. It's a good start. We just need to continue to keep our eye on it, see it expand further. On the 10-day, we're still less than 1%, which is fine. Anything more than 0.5% on the day is enough. We kind of top out underneath that 1.5 range. If we look back at what we were doing quite a bit last year, we were topping out just shy of 1.5 with some occasional spikes above. We're not overbought. We're not overextended. We haven't moved too far too fast. And after correcting sideways long enough, which we can see back here when we were chopping back and forth around the 10-day, when we're correcting like this, it gives everything a time to kind of heal and adjust. We've done that. We've corrected. Now it looks like we're ready to start expanding. So keep our eye on how far away from the 10-day we get. If we get more than 1.5% away from the 10-day, then we start getting into that area where we've gone a little too far, a little too fast, and we expect it to pull back, digest, correct in some way, whether it's a correction in time or price. This is the range from last week. If we set that on the range for this week, you can see that the current week's range is more narrow than last week's range. Now, at first glance, you might consider that's because there's less volatility this week. But there's two ingredients for how wide this range is. One ingredient is volatility. If we have more volatility, the range will be bigger. If we have less volatility, the range will be smaller. But the other one is time. Last week we had 5 days, the week before, right? So kind of comparing a 5-day trip to another 5-day trip. But this week is a 4-day week, so you have less days. If you just tie that analogy into a car, if you're going 70 miles an hour, great. Every hour you can look and say, yeah, we went 70 miles. But if you're only going to travel for 40 minutes instead of an hour, can't really expect to get 70 miles in 40 minutes when you didn't travel 60 minutes. The range on the week is smaller because we have 4 days. The sneaky part is we could also have some shift in volatility and it wouldn't stand out because we would just attribute it to the idea that, well, it's a 4-day week. Maybe, but 4-day weeks have been tied in with, say, OPEX week or, some other event that just went right under the radar because we didn't catch it, thinking, well, it was just a 4-day week. So keep your eye on the volatility levels. Which is not a bad idea anyways, to get a feel for what the average volatility looks like so that we get an idea of what unusual volatility looks like. It won't work if you're looking at the ES, but if you have the VIX, the VIX is a 30-day reflection of the SPX. So if you take the VIX and you add the number 1 behind it, you can look at the 1 day. That's the really close front end of the volatility structure. So if you don't know what normal volatility looks like, put the VIX on the 1 day, you got a pretty good idea of the day-to-day volatility and whether or not it's increasing or decreasing. You can also use like the 9-day, 6-month, 1 year. There's all kinds of VIX choices. Bitcoin down more than 1%. Bonds down, but not down enough. They're close. They're just not there yet. If we look at things that are up this morning, just kind of start the benchmark at 0.5%. We've got the Mag 7, uranium, more tech, emerging markets, which is basically China, chips, the VIX, oddly enough, more Mag 7, China, gold miners, China again, and China again. And the NASDAQ volatility is up. Now we've got solar. It's just not quite up enough. And we got biotech, growth. Those just need a little bit more push and then they'll be up enough. So we have the backdrop for a really good market move. Just needs to follow through. Pot stocks are up. I see some talk on Intel, 2 different companies trying to buy 2 different parts of Intel. The idea being that if they broke the company in half and, sold half to one company, half to another company, I don't see it coming though. I mean, who knows, right? But Intel's been trying to fight off everybody else forever. It's just keep your eye on the headlines when it comes to Intel. Even the article that I read on it, they weren't able to cite anybody. It was a lot of rumor and conjecture and doesn't really seem based on any hard evidence or facts. But we got a pretty good backdrop. Chips lead the way. Got the Mag 7 as a good starting point. Kind of need to keep it. I point this out all the time, but if you're going to keep your eye on the S&P or the NASDAQ, playing on the indexes, and you're focused on today on whether or not we're going to have a breakout day, a good run, rally day, you got to keep coming back to the idea, what would cause us a breakout or a breakdown? What would cause us to actually move somewhere? If we don't have any big economic events on the table, then you can take those off. It won't be that. If we hadn't already had a really good breakout and run, then we can't look at it and say, well, we were bullish in, the Asian session, it rolled into Europe and now it's coming into us and we're just continuing the run. We don't have that. Big name earnings, we've already pretty much gone through the big name earnings, so we don't have that. We can get some options flow after 9:30. We're not going to see that in the charts, right? So there's nothing to look for there. We got some Fed speakers today, but it's likely they're not going to move the needle unless they just come out throwing fireballs, deliberately trying to shake the market. So that leaves us with random headlines that can come out and move the market, or some options flow that can come out and move the market. And we've got a good start. We've got breadth, that backdrop of the Mag 7, China growth, precious metals. So when we look at the backdrop on breadth, 25% of the S&P is up 0.5%, and that's a good start. And it's the right kind of names, the Mag 7 names and chip names. So, if we're going to have a rally day, the sectors that are rallying are really important. You don't want a rally day based on pot stocks and solar companies. That's not the kind of rally we want. So when we see it's in the Mag 7 and chips and technology and a little bit of financials, we could use some more of those. But it's a good start. And it's the kind of rally day that can stick. We got 35% of the NASDAQ up more than 0.5%. That's a really good start. Now it's still early in the day because I do my morning briefings early. You'll want to check those numbers again when we get closer to the open. And then of course, once we are completely open, you can look at the advancing minus the declining issues. There's a lot of ways to do this, but on Thinkorswim, they have this index watch. And you can see the advancing minus the declining issues and the money flow, which is really nice. You got the capital and the volume and the issues. The issues are companies. So for the NASDAQ 100, Google's counted twice, so that it's actually 101. You can set this up, keep your eye on the NASDAQ 100, the S&P 100. Look at the amount of capital that's coming in, how many advancing, how many declining, and you can see that breadth. Keep your eye on it, see if we can get it into the 80s or 90s. Then it won't matter if it's just the Mag 7 or not. We'll have the rising tide lifts all boats scenario. and we can get a backdrop with everything moving. So watch the clock. Keep your eye on the Fed speakers and what they say. Make sure they don't get taken out of context. Look for the options flows to really be the game changer, because we've already got the stocks moving in the background. It's a good start. We want to see the market get supported with those options once the bell rings. Everybody, be careful, be